In today's complex financial environment, understanding interest rates is vital for smart investing. These rates influence borrowing costs, savings returns, and asset values, making them central to any investment strategy. When rates rise, bond prices typically drop, affecting the fixed income market. Higher rates also make borrowing more expensive for companies, often leading to lower stock valuations. On the flip side, low rates can lift stock prices and improve bond yields. Knowing how rate changes impact various investments helps you make better decisions and protect your portfolio. Understanding interest rates. Interest rates represent either the cost of borrowing or the reward for saving. When you borrow from a bank, you repay the loan with added interest. When you save money in a bank, you earn interest as a reward. These rates are influenced by economic factors and are typically set by central banks. Rates rise when inflation is high to cool down excessive spending, making loans more expensive. When the economy slows, central banks may lower rates to encourage borrowing and investment. In the U.S., the Federal Reserve sets the federal funds rate, guiding all other interest rates. High employment, strong growth, or rising inflation may prompt rate hikes. In contrast, high unemployment or recession often results in rate cuts. Understanding these shifts helps manage debt and make smarter investment choices. Investment strategies for changing rates. When interest rates shift, investment strategies must adapt. A key strategy is diversification, holding a mix of stocks, bonds, and real estate to spread risk. These assets react differently to rate changes. Stocks may fall when rates rise, while real estate can remain stable or increase depending on demand. Different stock sectors also respond uniquely. For example, tech companies might suffer due to borrowing costs, whereas utilities with consistent dividends may perform well. In bond investing, managing duration is essential. Duration measures a bond's sensitivity to interest rate changes. Longer duration bonds are more affected by rate increases, while shorter duration ones provide more stability. A balanced mix of short, medium, and long-term bonds can help reduce risk. Alternative investments. Alternative investments offer another layer of protection. These include commodities, hedge funds, and private equity. Assets not directly tied to traditional markets. For instance, gold often acts as a hedge against inflation. Hedge funds use strategies that can profit during market volatility. Real estate investment trusts, REITs, also offer diversification. They allow investors to earn dividends from property income without owning physical buildings. Alternatives can provide returns that aren't closely tied to interest rates, says Devin Garofalo, CEO of Colonial River Wealth Management. It's important to understand the risks and ensure these investments align with your overall strategy. Successfully navigating interest rate changes means staying flexible, informed, and diversified. Through smart asset allocation, duration management, and strategic use of alternatives, you can strengthen your portfolio against uncertainty. The future may be unpredictable, but preparation and adaptability remain your best tools. Disclaimer: this content is for informational purposes only and not financial advice. Always consult a qualified advisor before making financial decisions.